A great day to everybody, this is JT. Now I want to start to create simple tutorials in basic accounting. I'm not a pro, just gonna provide the basics and I hope I'll be able to help you somehow. If you are an ABM student, if you are a freshman in a university, and if you are a business student, or if you are just curious about it, even though you're not a business student, if you're just a curious person out there, if you just want to know something about it, this video is for you. Here I have my visual aids there. I used these when I had my teaching demo last year, so I taught for a year. And this year I'll be doing an accounting job. Actually, I still want to teach, but I want to have an accounting job experience, so maybe I can do teaching here just like what I've been doing as an ESL tutor. So let's pause this. Alright, our lecture for today is all about the statement of financial position. It's always important to know your objective, so you can ask yourself later if what you have learned and what you still have to learn. So our learning outcomes, number 1, we're going to review the accounting equation. Number 2, we're going to identify the elements of statement of financial position. And number 3, we're going to classify the elements into current and non-current. And of course, if you know those things, you will be able to know how to prepare the statement of financial position. I think it's important for us to have a short review before proceeding to our main topic, which is the accounting equation. Of course, assets equals liabilities plus equity. So assets, these are the economic resources. Liabilities, these are the obligations. And equity, that is the residual interest after deducting the liabilities from the assets. So since we're talking about this, let's review what an account is. So an account is a device used to record the changes in the accounting elements, which are the assets, liabilities, and equity. Examples of these accounts, we have cash, merchandise, equipment, accounts receivable, capital, accounts payable, and drawings. So these are just examples of accounts. Later we're going to talk about what these accounts are. And what is a transaction? A transaction is an exchange of values between two parties in terms of money. Simple example, for instance, you get a trousers at the mall and then you have 1,000 pesos. You gave it to the cashier. Now the cashier gave you the trousers, right? So that is a transaction. There is an exchange of values between two parties, you and the cashier, and in terms of money, since you gave 1,000 pesos to the cashier. So there is an exchange of values between two parties. And when we have those transactions, that is the time for you to record, right? So remember that, and that gives rise to double entry bookkeeping. It's a method used to record business transactions in terms of dual effects on the accounting equation. So whatever you record, your assets is always equal to the sum of liabilities and equity. So after those transactions, after you have recorded, after which the accounting information will be accumulated. And what summarizes this is your financial statements. And one of those is the statement of financial position. So now let's have our topic, the statement of financial position. The statement of financial position is also called the balance sheet. So it presents the resources, the obligations, and equity at a given point in time. It's at a given point in time. So if you have cash today, for instance, you have 100,000 today. So how much is your cash today? How much is your inventory? So it's at a given point in time or at a particular date. For instance, our reporting date is December 31st, 2017. Let's say your cash is 100,000. So that is the amount of cash that you have today. Remember, the balance sheet accounts change whenever there is a transaction. So our statement of financial position, so it's at a given point in time. It presents the assets, the liabilities, and equity at a given point in time. So those are our three elements of the statement of financial position. First, we have the assets. Assets represent things of value that a company owns. So what do you do with those assets? You're using the resources, right? Meaning they are beneficial to you. So assets are the economic resources owned and controlled by the entity arising from past events from which future economic benefits will flow to the entity. Got it? Personally, what are the things that you have? You have money or cash, that is the account title for it. You have clothes, at home you have tables, chairs, etc. So those are assets. In the business setting, what would you see in the office? Maybe you would see the office, of course, or the building. You would see office supplies, the computers, furniture. So those are the assets of the company. Assets, the resources, the economic resources of the entity. Next, liabilities. Number 2 element, liabilities. Liabilities are what a company owes to others. For instance, if a bank granted you a loan amounting to 500,000 pesos, then you are obliged to pay the amount including the interest, right? That is now your liability. That is your obligation. Sometimes the reason why we don't understand a statement or a problem, it's because of these jargons. These are the special words or expressions used by a particular profession. Anyway, just saying that. So when we say liabilities, we're simply talking about debts. Now, the third element is equity. Equity is the owner's investment. The owner's investment. So a while back, we said that the equity is the residual interest after deducting the liabilities from the assets, following our accounting equation, right? So that is equity. When you put your money or property into the business, that is your investment or capital. But this account decreases when you withdraw. For instance, you get cash from the company that is to be used for your personal transaction. So that is the drawing account. The drawing account decreases the capital account. So it's part of the equity. Got it? Equity is also called net worth. Equity is the difference between assets and liabilities. Remember your accounting equation. Assets equals liabilities plus equity. So it's A equals L plus E. It's like 10 equals 4 plus 6. A asset is 10, L liability is 4, then equity is 6. To get the value of the equity, it becomes A minus L equals E. So 10 minus 4 equals 6. Now let's proceed with the current and non-current classification of assets and liabilities. These are incredibly important when presenting a statement of financial position. Assets are classified into two, current assets and non-current assets. Current assets are assets to be realized within the normal operating cycle or 1 year. By the way, in accounting, when we say realize, it means to convert into cash. Our current assets can be easily converted into cash. For instance, we have your inventory. When we say inventory, those are the things that you sell. So in a merchandising business, if you're selling, every now and then you receive cash. So they can be converted into cash easily. Receivables are also current assets. And cash, of course, it's already cash. It's a current asset. So current assets are also called short-term. Next, we have the non-current assets, of course. Since current assets are called short-term assets, non-current assets are called long-term assets. So all other assets that were not classified as current, classify them as non-current assets. So non-current assets are also called fixed assets. Building, equipment, furniture, these are just few examples of non-current assets. The same with liabilities. We have current liabilities and non-current liabilities. Remember a while back we discussed liabilities. These are obligations or debts to be settled or to pay, right? So we have current liabilities. These are the liabilities to be settled within 1 year. Just like your current assets, they are called short-term assets. Here we have current liabilities. They are called short-term liabilities. Example, accounts payable, salaries payable. So those are current liabilities. Non-current liabilities, these are long-term financial obligations. For example, mortgage payable, loans payable. We pay them yearly. However, of course, it takes like 3 years, 5 years. So we were able to identify the elements of the statement of financial position: assets, liabilities, and equity. And of course, two classifications of assets: current assets and non-current assets. And two classifications of liabilities: we have current liabilities and non-current liabilities. Now let's classify the accounts. I have here another visual aid. I also use this. So we're going to classify them if they are current and non-current, and later we're going to present the statement of financial position. Now let's classify these accounts of ABM company as of December 31st, 2017. Sorry, they have already the answers because I've used it last year, so just being resourceful. Alright. Now we have the first account, we have land, 500,000, since we're gonna use land for a long time, so it's a non-current asset. Next is furniture. Of course, it will take 3 years or 5 years before we replace them, so it's also a non-current asset, 80,000. Next, prepaid expense. It has the word expense. Remember, what are the three elements of your balance sheet? We only have assets, liabilities, and equity. So here we have the word expense. Would it be part of your statement of financial position? No, because it has the word expense. So it means it will not be part of our balance sheet. Prepaid expense is part of our income statement. But here we have the word prepaid. Prepaid overpowers the word expense. Prepaid expense, meaning paid before. If it was paid before, meaning we're going to use it in the future. For example, when you buy a load, you're going to buy a load and then you're going to text somebody, call somebody, then meaning it's a prepayment. You're using it. You're about to use it in the future, so that is an asset. So it's part of our statement of financial position, classified as current asset. Just like when you buy a load, for example, you have paid for it. Number 4, bonds payable. If you issued a bond, you are the issuer, of course, and another party will purchase this bond to help you financially, meaning you're gonna receive the cash, and the other party is the bond holder, and that is the creditor. Now, you're gonna have a liability in the form of bonds payable, right? And bonds payable is a non-current liability. Number 5, advertising expense, 5,000. So for you to be able to sell, you have to advertise, and the cost incurred will be recorded as advertising expense. And this is a selling expense to be reported in your income statement or in your statement of comprehensive income. So it's not an asset nor a liability, because now we're just talking about the statement of financial position. This is an expense to be recorded in the statement of comprehensive income under operating expense. Now we have salaries payable. You have to pay the employees. So that is salaries payable. Payable, not yet paid. So it's a liability, it's a current liability. You have to pay the employees. So that is salaries payable. payable, not yet paid. So it's a liability, it's a current liability. Number 7, interest payable 5,000. It's a current liability. Interest payable. Payable. To be paid in the future, so that is a current liability. This is the amount of interest that has been incurred but not yet paid. So, interest payable, current liability. Number 8, Maman drawing. Let's say Maman is the surname of the owner. Of course, again, we discussed drawing as a deduction from the capital account. Since it's a deduction from the capital account, it will appear under equity. Building 260,000, so we use it for years. Definitely, it's a non-current asset. Building, non-current asset. Accumulated depreciation is a contra asset account. It's a deduction from the related asset, which is the building in our example. So in this case, it's a deduction from the building. It's not an asset nor a liability, however, it's related to the building, which is a non-current asset. In our statement of financial position, we're going to present it under building. So after building, you're going to write it accumulated depreciation, building, 10,000. Or sometimes we can present it as the net, 250,000 without the depreciation. So building, comma, net, 250,000. But we can also do this one, we can include accumulated depreciation after the account building in our statement of financial position. Number 11, accounts payable 112,500. As discussed a while back, it's a liability. Accounts payable, it's a current liability. Next, Maman capital. Again, capital is an investment, so it's under equity. We have 618,200. Next, long-term loans. We already have this long-term, so definitely it's a non-current. Loan is a liability, so long-term loan, it's a non-current liability. Next is accounts receivable. Accounts receivable is a current asset. Accounts receivable is the opposite of accounts payable. Receivables are the debts owed to the company. Now we are the creditor. The goods have been delivered to the customers but not yet paid. Or if we're talking about service business, the service has been rendered but not yet paid. So we are about to collect the customers. So that is accounts receivable asset. Current or non-current? Current asset. Next, we have number 15, cash. Since it's already a cash, it's a current asset, 180,500. And number 16 is inventory, 120,000. So it's a current asset. Inventory, the goods that we sell in a merchandising business. But actually in manufacturing business, we have 3 types of inventory. These are the raw materials, work in process, and finished goods. Next is utilities. Utilities or utilities expense. This is the cost of the usage of utilities such as electricity, water, telephone bills. So that is an expense, not to be included in our statement of financial position because it's an expense. Expense is to be reflected in your income statement. So those are the accounts that we're about to. So these are the accounts that we had. Now we're going to summarize them by preparing a statement of financial position. Finally, we were able to classify the accounts. In preparing a statement of financial position, the heading is very important. Start with the company name, then statement of financial position, and then the date, as of December 31st, 2017. But there is no given information about the equipment. Now, how to solve for the value of equipment. Do not forget your accounting equation. This is the very heart of accounting. Assets must always be equal to the sum of liabilities and equity. Total liabilities and equity is 150,700, meaning our total assets must be also 1,250,700. To get the value of the equipment, we deduct the total assets excluding the equipment from the real total assets. Now we will get 80,000. Do not forget the double rule or double underline. You're not an accountancy student if you don't know this. By the way, when preparing a financial position or a balance sheet, we have two formats. We can use the account form or the report form. That ends my video. I hope to see you again on our next lecture.